You're not alone. I got a flurry of reports. You got Goldman, Morgan Stanley, Barclays, all of a sudden coming out and saying, oh my gosh, we're going to see the market turn faster than we thought. What happened in the last 4 weeks?
Well, we've been saying really since February that we thought the second half of the year would be quite different because we could see production going down in the United States, and that production is now accelerating. And I think that's one of the things that's caught everybody's attention. The other thing is that we have seen a series of disruptions that tell you as the market tightens, disruptions would be more significant. So our notion of around $50 in the second half is based upon no major disruptions. If you have Venezuela blow up as some fear, then we could be looking at a different situation.
How different?
Well, I think it would obviously be higher prices. We can't, at this point can't say what it is, but you've seen, 1 million barrels a day of Canadian oil sands are out now. Nigeria is down to levels it hasn't seen in several years. So already there are these disruptions eating at the market, but we've had enough supply to offset them. But it's going to change. Downturns don't last forever, and this one really started 18, 20 months ago.
Dan, many of the big banks who've come out and raised their forecast for the short term say things like, we're going to see lower prices in the third quarter because refinery maintenance. That was Bank of America. Goldman Sachs sees weaker prices in 2017 in the first half because they think more supply will come online. What do you think?
Well, I think there are two sources of supply that would come online. One would be somewhat of a recovery or a stabilization in U.S. oil production. The other thing is a new stance of the big Mideast producers led by Saudi Arabia, and they're sending a different message now. They're sending a message about putting more supply into the market, and of course Iran wants to put more supply into the market, so that's there. But we see next year, assuming, about 1.3 million barrels a day of demand growth, and that's kind of where we start to see the balance. But we really think we start to see the balance in the third quarter.
I have a great chart that I wanted to share with you guys. It's the forward curve of oil now versus what it was just a month ago, just to take in mind like what re-rating we've seen in the market. Take a look at the Bloomberg here. The orange line is the current curve, so what prices will be now and what prices will be in 2014. And the green line on my computer screen is what that expectation was just a month ago. If we can, nope. Okay, we don't have that chart. Anyway, point being is we've really seen the curve flatten a little bit. Dan, why do you think prices have come up in the short term but down in the long end of the curve?
Well, I think because people still expect that you'll see the short cycle oil, which is the United States, come back. $50 a barrel, we probably stabilize production above that. As one CEO said to me, when you have line of sight of 60 is when you start to see production really starting to increase again. And you have a different policy coming from Saudi Arabia. In the last month, the Deputy Crown Prince, the new energy minister, and the head of Saudi Aramco have all talked about increasing production. And you hear that from some of the other producers, too. So those are the factors that are kind of weighing on that side. But I think as you also, the charts show you, expectations are one thing, and what happens in the market is something quite different.
Absolutely. U.S. production being kind of the swing barrel here, or what a lot of people refer to as the swing barrel. It peaked at, 9.7 million barrels a day in April of 2015. It's been falling. Do we have any indication of where it will bottom at?
Yeah, we think it will bottom sometime in the second half of the year about 1 million to 1.2 million barrels a day lower than that peak number that you had. In other words, around 8.4, 8.5, 8.6 million barrels a day. And that's at the point when we start to see it stabilizing. It's not quite the swing producer, at least in our minds. We think of it as short cycle, because you still got to find all those people who've left the business, who've gone and gotten other jobs. I don't think we'll see the kind of fevered production growth that we'd seen in the period before the price collapse, but we would see a steadier increase. And of course, these producers are ingenious. They brought down their costs. They can operate at a lower cost level.
I love that. I've heard a lot of people go be Uber drivers. That's what CEO tells me. They've left the rigs and they're going to be Uber drivers. Yeah, so you got to get them back to work.
Right. Well, then the question is, will they drive back to the rigs?
Right, which is more profitable. Okay, Dan, What is the longer-term replacement cost for oil? What oil price do we need to see for production to come back longer term?
Well, I think there's not a single price. It varies, but the areas that's the low cost is the Mideast, and I think what we've seen is that the Mideast producers are much more focused on the fact that they're low-cost producers, and therefore they feel that they should build on that from a competitive point of view for market share. Shale oil was thought to be high cost. It turns out it's mid-cost range. The high cost are things like new oil sands, ultra-deep water, and those are the investments that will be the slowest to come back, and those are the ones where you've really seen the big cuts that you can't just turn on a dime.
Got it. All right. Well, Doha came and went, and nothing came out of it. So my question to you, Dan, is could anything interesting come out of the June 2nd OPEC meeting? What will you be looking for?
Well, I think once again the Russians are talking about a freeze, and they're in discussions with Qatar and other countries about it. I think the key question is Iran's production stabilized? It's still increased. And the Saudi view is that they're not going to cut back or freeze or do anything while Iran is still increasing. Meanwhile, just recently, the Iranian oil minister said we're in an undeclared oil war with Saudi Arabia. The countries don't even have diplomatic relations with each other. So I think it's pretty hard to have any deal at this point. And I think some of the producers may shrug and say maybe we don't need a freeze now. Remember, the freeze was February, which was really the bottom of things.
Sure, and then Nigeria really picked up after that. Do we really need OPEC then? I mean, if Saudi Arabia is not going to be using production as a way to balance supply and demand globally, what's the point?
Well, I mean, OPEC is, there have been many epitaphs that have been said for OPEC. I think its role changes at different times. It's a framework when producers want a framework for things, when they're able to work together. I think right now, the clash between the competition between Iran and Saudi Arabia makes it very difficult for OPEC to do anything. I think it's at the times when they decide it is in their interest to have a framework, that's when you'll start to see it be more active again. But it brings them together and gives them an opportunity to talk to each other.
Maybe.
Maybe. Exactly.
Or not.
Or not.
Or not.
You mentioned how Saudi Arabia and Iran don't even have diplomatic relations with each other. So obviously there's a lot of geopolitical tension there. Alix has talked about the militarization of oil here. What do people get wrong the most, Dan, when it comes to Saudi Arabia's willingness to go toe-to-toe in this fight for market share with Iran?
Well, I think there are two things that are happening. One, it's a battle for market share with Iran. The other is the impact of this reform strategy, which will change not only Saudi Arabia, but also will change the oil market. And so I think they have a much more competitive strategy than in the past. I think what's striking is what maybe we don't see here is just how deep the rivalry between these two countries are. The Saudis and the other Gulf countries believe that they're surrounded by a militant Iran, and they regard the nuclear deal, possible détente between Iran and the United States as a threat. I mean, these relations really have frayed. And it's striking to see that last year, the third largest military budget in the world was Saudi Arabia, after the U.S. and China, and ahead of Russia.
And the other, I just want to wrap it up here talking about Nigeria, because you mentioned Venezuela and you mentioned other oil outages. Take a look at the Bloomberg here, guys, and you can really see what we're talking about when it comes to Nigeria. This is oil production currently. It actually, my estimates from other analysts say that it could be even lower than 1.7 million barrels a day. But look at that unbelievable steep decline. Are we in the kind of scenario, Dan, like in the early 2000s where Nigeria is just shut for a long time due to all this disruption in the country? You know,
that's very interesting, because the two countries whose disruptions started things in the early 2000s were Nigeria and Venezuela, and maybe we are going to see a repeat. This is a really tough situation for Nigeria, because 70% of its government revenues have been coming from oil. Prices are way down, and they're losing supply, which raises questions about security in the country. They have other problems. So Nigeria is a country with a lot of problems too, and that is, Nigeria's moved to the fore with Venezuela, with the oil sands in Canada, as one of the factors of disruption right now, as well as the continuing disruptions in Libya. So all of that has to be balanced into what we call the market balance.
So your $50 call, though, doesn't really factor in those estimates yet. I mean, if you factor them in, are you looking at $80 oil?
Well, I wouldn't want to put a number on it. I mean, even $50, by the way, does not really provide the signal for the investment that you need for demand to meet demand over the next 5 years. Demand could grow over the next 5 years by 5 to 6 million barrels a day. So you're going to need a lot of investment on top of it. So 50 is just a waiting station. It's not a permanent destination.